Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark on how positive employment numbers have given the U.S. dollar a bounce up. InsideTrack.com founder Eric Hadik explains how 17 and 40-year cycles could influence your investments. We talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Nice to be with you, Jim.
U.S. employment numbers encouraging for the markets, were they?
Very encouraging for the dollar. You had good number. That's the U.S. dollar we're talking about here. 271,000 increase in the jobs in the U.S., taking the employment rate down to the jobless rate down to 5%, a very low number. On the Canadian side, we ended up with 44,000 new jobs. A lot of it driven, though, by part-time workers, so you get a modest increase in the full-time positions. And the result, as we have said in the past, so many of the times when we look at it, it's all about the currency action, and today was definitely one of those. The dollar, U.S. dollar, was up about 1.25% on the day, and that takes it well out on the upside of this bullish pattern we've been looking at for the last couple of weeks. The consolidation from March had pretty much run its course here as of about 2 or 3 weeks ago. Started to see positive action, and the dollar index is up at 99. This is up from 94 and change just a couple of weeks ago. So 5% move in the currency. That's pretty good for a dollar index. And we take a look at the long-term cycles there. The 16-year cycle that I work with still points for a high somewhere out in 2017. This part of the move, I think, probably finds a reasonable target up in the 103 to 105 level on the index. And for the Canadian dollar, on the reciprocal side of it, that puts a lid on it for us. Now, we did get oversold enough there back in August that I think the consolidation that we've been in since then probably can run itself for another month or so. But the Canadian, clearly the long-term trend remains to the downside.
How is gold doing?
So there we were. The U.S. dollar up 1.2% on the day, gold down 1.4%. So you can see that the currency action having a direct impact over into the commodity side. Silver down about 1.5% on the day. And, clearly 2 and 3 weeks ago we talked about how high the open interest numbers, the commitment of traders figures were for the speculative longs in gold and silver and for the commercial shorts. And the positions there in silver in particular were the highest that we had seen since the top of the market. So it meant that any negative action in price was probably going to feed upon itself just because you've got so many of the wrong players in positions that they can't afford to ride out anything negative. So price of gold closing off the week here under 1,100, closing at 1088. Typically, gold likes to become oversold and have hard breaks just under round numbers. And in this case, we've had 13 out of the last 15 days to the downside. So gold's probably just running its course a little bit now for this sell-off. But from what I can see on the commitment of traders numbers for as of this Friday, which are for data as of Tuesday, there has been virtually nothing in the way of selling of positions. So there's still going to be a lot of very offside speculators. I think that you could get a dead cat bounce, but probably see a continuation to the downside. I will post a chart up on the website for you, showing just the COT numbers and my interpretation on them, so that the listener can have the opportunity to view them.
And what's happening on the bond market?
Bond market, we put out reports here, and for people who listen to Bob Hoy, they'll know that we had looked for we'd seen that there have been 3 drives to peaks in the bond market this year. The first one right around late January, February, and then 2 successively lower ones as we move through the year. The most recent one was right up to a perfect resistance level in the charts that we put out. Just you could see that this was right where the lid should have been, and all it needed was a rollover in price. We look at the moving average convergence divergence called the MACD. That signal has confirmed a rollover in the bond market right now, and we suspect that this will run on for a number of months.
And that website, if you want to listen to this program again or check out some of the charts that Ross has produced over time, talkdigitalnetwork.com. Coming up next, Eric Hadik on This Week in Money, and thanks a lot, Ross, for being with us.
Nice to be with you, Jim.
Always consult your investment professional before making any investment decision.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Eric Hadik, founder of InsideTrack.com. He's speaking to us from Naperville, Illinois. Inside spelled INSIIDE. Eric, I have to ask, why the 2 I's?
That goes back to when I first started writing my flagship publication, Inside Track Newsletter, and was trying to figure out a name that would kind of convey what I was covering, although some of that has expanded since then. And it evolved into this acronym, because whenever you see the inside, it's all caps. That's because each letter represents another word. But it was the IN dealt with inflationary markets, which really encapsulated all of commodities that I followed. The SI was for stock indices. The second I was for interest rates, bonds, notes, and such. The D was for dollar and other currencies, and the E was for energy markets, all of your oil-related markets. So it was just a compilation of all of that. And when I was playing with it and saw the extra I thought, sometimes that's a good attention grabber too. People look at it and it spelled wrong to them. Of course, there also is a downside to that too. Sometimes they try to find my website and they don't put in the extra I, so I guess it's a double-edged sword.
Eric, the big news of the day going into this weekend is President Obama has officially rejected the XL pipeline, an $8 billion project that Alberta was counting on to get its oil down to the southern part of the states for refining. What kind of an impact is that going to have on the energy industry?
Well, although I don't claim to be an expert on the energy industry itself, it certainly could corroborate the cycles and the technical expectations I have been having for both the oil markets and the Canadian dollar. And it's often at the very end, the culmination of a longer-term trend, that could be up or down trend, that you see these type of fundamental confirming events that basically it's like in an uptrend, they give the final bullish confirmation, and in a downtrend, the final bearish confirmation, and you get a little bit of follow-through selling in this case, and then the move's over. And I have been talking about where oil and crude is concerned for a couple of years now. My work turned down sharply in mid-2014, and I thought that would create a drop in the price of oil all the way into December 2015 or January 2016. And it was interesting to me that I had pretty similar analysis and cycles in the Canadian dollar that I could see the greatest synergy of my cycles and other timing projection indicators that I use could extend that bear market into maybe about March of 2016. But the fact that the two are often so closely intertwined, that is certainly in sync with even this announcement that you get a little bit more bearish fundamental being this announcement and a capitulation sell-off in some of these related markets, and then a major bottom takes hold. So from that perspective, it certainly does not contradict anything that I'm looking for, and if anything, corroborates it. So from that perspective, I think that we're within a few months of a bottom in oil, even though, again, this might spur one final sell-off, although I guess really from the price of oil, that would start to become a little bit more of a bullish factor. But the overall industry could see a little bit more struggles before it bottoms.
I've heard there's a confidential report from OPEC that predicts oil prices will stay low for perhaps 5 years.
Well, I wouldn't necessarily give it a whole lot of credibility or credence because there's so many factors that are often out of their control. And the fact that I am looking for a major bottom does not, and this is something I have to stress so often, that does not automatically mean that oil prices are going to skyrocket 3 months after that bottom. That oil, price of crude, could drop down to the low 30s in end of this year, beginning of next year. You know, say it set a bottom around $35 or something, and I'm basing it more on the futures prices, which is what I look at the most, but let's just hypothetically say $35, and then for the next 2 years, it trades between 35 and 50, maybe going back up towards 60 at some point in there, and then back down to 37, 38. The OPEC statement would be accurate, that prices remained low for a few years, and the cycle low at $35 in early 2016 or late 2015 would also be accurate. Just because I'm seeing important cycle low doesn't mean that automatically ushers in a major bull market. It's just the turning point prior to the next bull market.
Eric, you follow a 40-year cycle and a 17-year cycle. Do they each follow specific markets, and what are they telling you right now?
First answer to that, I would say, for the most part, no, that I'm not talking about a specific market, but there are many groups of markets, groups of complexes that I am measuring and illustrating and analyzing where these cycles have an impact. And to your second question, what I really see, and I guess it's really important to state the obvious, that cycles of that magnitude are a much broader stroke type of, a generational cycle with respect to the 40-year cycle, and cultural things, geopolitical shifts. So it's the type of transitions that take hold over a multi-year period. So as far as something honing it down to too specific of a time frame is certainly not wise. But what I have been describing and discussing, and I think even in our previous interview we touched on some of this, was this recurring 40-year cycle that has to do with the currency, particularly in America, going all the way back to the American Revolution. And in fact, that was it was the first foray into kind of a fiat paper currency, the Continental, that plummeted from 1775 into 1781. Although it wasn't the first currency within the colonies, there was a very similar experiment back in the 1690s with the Plymouth Bay colony, or Massachusetts Bay Colony, that had similar results. And you'll notice that was exactly 80 years prior, so it's part of that 40-year cycle. But then every 40 years from the 1770s, you've seen a very similar battle that usually involves gold and silver, currency, whether it was continental, and then as it evolved into the dollar, and then into the Federal Reserve note, whatever you want to call it. It has really timed a battle among them. In most of those phases of the 40-year cycle, there has been a market panic. There have been many of the stock market crashes. There have been some bubbles in gold and silver and then crashes. And there have also been, what I've documented and illustrated, a recurring climate and food-related crisis that has timed either shortages and or famines on a very consistent 40-year cycle basis. And when you talk about the currency battle and the gold and silver, you go into the 1810s when Thomas Jefferson was battling against the rechartering of the Second U.S. Bank, and he finally lost that battle. The bank was rechartered in 1816, and by 1819 you had a panic and a crash. Then in the 1850s you had a similar thing where after the second charter was not rechartered, and you had gold and silver starting to take the forefront again. Then they started reducing the weight of gold and silver and basically devaluing it, and you had a crash in there. 40 years later in the 1890s, you had another bubble led by silver, and the battle between the western states fighting for a silver standard and the eastern and northern states fighting for a gold standard. 1930s was 40 years later. You had again confiscation of gold and silver, which really ushered in the whole inflationary environment we've had ever since then. The 1970s was kind of the culmination or the final nail in the coffin where that was concerned, where the Jamaica Accord came out in 1976 and was the final document to de-link gold from the dollar. And now 40 years later, you're coming into that same, right in 2016, 2017, is the recurrence of this uncanny cycle that has an impact on all of these markets that I was just discussing. There's even, I've documented that there's some very intriguing correlation to even volcano cycles and solar cycles. So whether they're all linked together, that it's basically a time of recurring instability, which would affect all of those things, or whether they're individual cycles that happen to closely overlap and correlate, I can't tell you exactly, and it doesn't really matter to me because I take a very practical and pragmatic standpoint to this, that I want to know where the opportunity is, what can be done about it, and that's where those broader cycles are good to kind of build the framework and set the backdrop, but then there's a lot more specific types of analysis and cycles that I look at to start bringing that into trading strategies and what to do about it. So I do see all of those markets, from gold, silver, and currency to stock indices to commodities like soybeans, corn, wheat, and other grains, all kind of coming to a tipping point in the coming years.
We'll have more with Eric Hadik, founder of InsideTrack.com, next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Eric Hadik, founder of InsideTrack.com. Eric, do you see any crash cycles on the horizon? In which markets? And what is the potential drop?
Well, I do, and I think we even discussed this a little bit in our previous interview. I do have crash cycles related to the stock market that told me to look for a multi-phased bear market in 2015 to 2016. And there were a number of overlapping and corroborating, sometimes a little bit competing cycles that really led me to that conclusion. And the scenario that I described about a year ago is pretty close to what we've seen play out. And the overriding expectation was that this two-year or longer decline would look somewhat similar to the bear market between 2000 and 2002 in most of the indices other than the NASDAQ. The NASDAQ, because of the dot-com bubble, was more of a straight-down affair during that period, where that index lost over 70% of its value. But most of the other indices, it was more of a volatile, two-sided affair for the first 12 to 18 months, really until middle of 2001. And I thought that we would see something similar play out in 2015-2016 due to a very diverse combination of indicators and cycles and even some fundamentals that I was watching. And that within that scenario, the first initial decline would be a 10 to 20% drop between late April and late September of 2015, with the most bearish cycles between May and August of 2015. And I have this in numerous publications and reports I did. I called May through August. I was expecting that to be the capitulation phase where you would see your sharpest decline, but then you would see sharp rallies follow it right back up, and it wouldn't be until 2016 that the second shoe would drop or the stuff would really hit the fan, and that is still what I'm expecting. We saw the declines, many indices, and a lot of bellwether stocks saw drops of 20, 25, 30, even upwards to 40% during that May through August time frame. And now many of those indices are seeing sharp rebounds in the fourth quarter. And so the whole general scenario is playing out very closely, and I think that 2016 is when those crash cycles are really going to take hold, and you'll see a more convincing decline in stock indices, both domestically here in the U.S. and across the globe.
Do you follow the presidential cycle, and what is it suggesting for 2016?
That actually that's a funny question, because I don't follow it that closely, but almost a year ago I actually had several subscribers asking me about it. And one had posed a very detailed question that I thought was great to address in the context of what I was looking for. And he cited several aspects of that cycle, one of them being that period from November to April 30th that coincided with the midterm elections and the first 4 months of the pre-election cycle were the best performing cycles in every election cycle. And then he was also discussing the decennial cycle, what the 5-year typically brings, and the broader presidential cycle that you're mentioning here. And he said to me, okay, so, a lot of things would argue that would create a very bullish 2015, and yet you're calling for a major top and a slowly developing bear market in 2015, and then kind of summed that up and said, how do you jive the two? And he even said that, he tended to side with what I was discussing, but wanted, to see if I had any comment on that. And it was a great opportunity for me to elaborate or reemphasize kind of the point that I was just making with the oil markets, that a major cycle high or low doesn't mean, and usually isn't, the onset of a new conflicting or opposing trend right away. It's just the turning point that leads to that. And so the answer that I gave him and published for anytime a subscriber asks something, the only way I'll answer it is by publishing it for everyone. And so I did this whole article where a scenario that I laid out for the end of 2014, all of 2015, and then 2016. And what I was saying to him was that there's a good chance that both of those analyses could be right, that I could be right, that we'd see a developing top, that the presidential cycle could still statistically be right, and all the market would have to do is close 1 point higher in 2015 than where it closed in 2014, and you could call it an up year, and that they wouldn't be competing, but they would, depending on your perspective and the context, would be signaling completely different things to different people. And so just some of the general things that I laid out, and again, I published this back in late November of 2014, I said that we could see the market close in 2014 around certain key levels, which was around 17,500, and that then we could see some selling in the beginning of 2015, and I'm just using the Dow Industrials as the benchmark here, although there were a lot of related numbers in many of the other indices, that we could see a sell-off in the beginning of 2015, a rebound into April 30th, so then you would have that November to April 30th 6-month period still showing positive, even though it would be very mildly positive this time, that we could close on April 30th around 17,500 and then enter the part that I thought would be the most bearish from May through August and even into late September, see a sharp drop of 10 to 20%, and then in the fourth quarter, we could see a sharp rally, again, looking much like the developing bear market of 2000-2002, and for good measure that the market might close in 2015 right where it closed in 2014, maybe up a few points, so that statistically you could say it was an up year, even though it wasn't at the very top. And then we would see the real stuff hit the fan in 2016, and that would also coincide with what I'm looking for in precious metals and many other things, that 2016 would be the year when some convincing trends would take hold. So within that scenario, it turned out that we closed 2014 in the Dow. The exact closing level was 17,823. We saw some selling in the beginning part of the year. Then it rebounded into April 30th and closed at 17,840. So it was up 17 points for the year. Certainly not a overwhelming bullish affirmation, but from a statistical standpoint, you could once again say that that period was positive, and then the markets immediately entered a significant decline, many of the indices dropping 20 to 30%, and then a sharp rally in the fourth quarter, which is exactly what we're seeing, and we're trading right around that 17,800 level again. So if we close the year somewhere around here, even though we could see a decent decline between now and then another sharp rally, all of it would really just show some volatile consolidation, which you often see at major turning points. It would fulfill the necessary criteria of the presidential cycle, and at the same time be validating and fulfilling what I was expecting for an initial 10 to 20% decline in 2015 and then a sharper decline in 2016. So far that scenario they've kind of really coincided, the one dovetailing with the other, and to me it's just really reinforcing my expectations going forward from here. Now, as far as the actual election year, I'm looking for that to be more bearish than I think what a lot of people are expecting.
We're speaking with Eric Hadik, founder of InsideTrack.com, Inside spelled INSIIDE. Eric, taking a look at the 40-year cycle, 40 years ago we had Prime Minister Pierre Elliott Trudeau. Now we have his son, Justin. Is this part of it? When you said generational changes happen, we have a new, fresh mind at the head of our government. And the U.S., I think, they're trying to find a candidate for president or candidates for president who maybe have a fresher idea or ideas as well.
That's a very intriguing application of the 40-year cycle. I have to admit that I wasn't even following Canadian politics that closely to realize that correlation. But one thing I did point out recently was when I was discussing the recurrence of food crises and droughts and crop shortages. I was noticing and kind of pointing out that in the late 1970s, 76, 77, was when California suffered one of its worst droughts in history, and that impacted food production, and there were some related drought. That wasn't the only one, but that was the most significant. And at the time, Jerry Brown was the governor of California. Lo and behold, here the 40-year cycle's coming back into play. I'm looking for another food crisis. California has been in its almost worst drought since then, and guess who's in office as governor of California? It's Jerry Brown himself. It's not even a son or anything. And so there are certainly some intriguing applications and coincidences that do play into that 40-year cycle. But I definitely look for a lot more synergy of things and repetition of things, more data points too, before I'm going to start applying it looking forward and saying, okay, I expect this or that to happen. But all those things to me just reinforce the validity of the cycle itself.
Taking a look at the bond market, what are the cycles telling you about bond prices and bond yields?
I have been looking for a very slowly developing top in bond prices, bottom in the corresponding interest rates, and that could take years to really play out and slowly roll over and turn down on a more intermediate basis, a 6 to 12 month basis. I have some very important cycles coming into play at the turn of the year this year and also the following year. And by that I mean December 2015, January 2016, some very significant cycles. And then in early 2017, January 2017, some additional cycles. And I think that they are going to be some of your landmark turning points and watershed events that begin to reinforce that a bottom in interest rates is taking hold, a top in the bond prices is behind us, and a new bear market in bonds is underway. So that's what I am looking at where that's concerned.
Do you have 2016 cycle predictions for gold and silver?
That is probably one of my most prolific cycles and analyses that I've been doing. I even titled some report over the last 2 to 3 years. The title of them was 2016, the Golden Year, and that my analysis since 2011 and particularly since late 2013 has been that gold and silver would continue their declines into 2015, that we would see a major bottom in 2015, and then that 2016 would be when an initial advance really takes hold. Within those yearly cycles, within 2015, the highest percentage probability, based on synergy of cycles and indicators, was that I expected July of 2015 to be that major bottom in gold and silver. Gold did bottom in late July, rebounded. I was looking for an initial 1 to 2 month rebound, and then even as that July low was unfolding, I was describing why I thought November would be a subsequent low, and we are seeing that play out as gold and silver saw a 2.5 month rally, and now they're selling off into this November cycle low, which is it's the recurrence of a very consistent 4-month pattern that we have seen in the metals for the last couple years, and it goes back to March and July of 2014, which then had me anticipating an intermediate low in November of 2014. Once that took hold, I described why I thought that March of 2015 and July of 2015 would see the next lows, and then that if the major bottom took hold in July of 2015, that 4 months after that we would probably see a subsequent low in November, which could be a retest of the July 2015 low, but that the real bull market, the real advance in gold and silver would wait until 2016. And so all of that is still my expectation, still my outlook, and everything we've seen since July has been a pretty strong reinforcement to that outlook.
Does that apply to gold and silver stocks as well?
That is one of those things that I've had to really stress, both the similarities and the distinctions between the metal and the metal stocks. And from a cycle standpoint, where I do a lot of analysis on the XAU index just as a good broad stroke gold and silver stock index. And for me, it had critical cycles in September and November, December of 2015, both of which should be lows. But it had its longest term cycle lows at the very end of 2016. And there's even this very consistent 8-year cycle between significant lows in that index. And looking at that, and looking at my outlook for the metal, I ask myself, okay, number one, I could be wrong on one of those two things, but that's not the assumption going into it. It's, okay, if both of these are going to be right, what type of scenario might that be alluding to? And I could certainly see that being consistent with everything I expect, and that is that we see a strong move up in precious metals throughout 2016, and when that rally is accelerating, when it's in its more convincing and strongest part of the overall advance, that the gold and silver stocks would be rallying with it. But at the same time, I'm looking for a sharp decline in the overall equity market. So you've got a real competing cycles when you're talking about gold stocks. If gold is looking positive but stocks are looking negative, there's a real tug of war going on there where gold stocks are concerned. So you may see gold and silver see a big, say, 1 or 2 month run up, and gold and silver stocks go up with it, and then the actual gold and silver, maybe they just plateau at a higher level and kind of trade in a range up near their highs. But while that's happening, the overall equity markets could be going through a serious sell-off, and the gold and silver stocks selling off along with the equity market, even though gold and silver are holding at those higher levels. And maybe that drives the gold and silver stocks back down towards their lows. Then the equity sell-off dries up for a little bit. Gold and silver see a new rally, and the gold and silver stocks rebound with that. That type of scenario and that type of correlation between different markets has played out dozens of times in different markets, whether it be dollar in the gold, whether it be bonds and stocks. When you try to draw a direct, 100% consistent correlation between two markets, you usually get burned. It's only when the lead market is in its strongest phase or in a parabolic move that you see those correlations hold really tightly. Then when that lead market goes into consolidation, the other market starts to be impacted by other forces. So if gold and silver go into consolidation, then the gold and silver stocks start to succumb to stock bearishness if that unfolds the way I'm expecting. So kind of long answer to your question, I think that gold and silver stocks will have a good rally next year, but that they could also go back and retest their lows by the end of next year, which would be a little bit different than what I'm expecting for the actual precious metals. And I should even say that that's not unprecedented, because if you even look at the moves of 8 to 10 years ago, that gold, the actual metal, saw its biggest move from 2008 to 2011. The majority of its advance was in that 3-year time span. The XAU index, as a good comparison, spent that whole time just struggling to get back up to its 2008 peak, and then it just barely spiked above it and then sold off again. And it's been down near 20-year lows now, even though gold has only retraced, $800-900 from a $1,900 peak. Less than 50% of its value it's given back, even as the gold and silver stocks have just been decimated since 2010, 2011. So it's a scenario that has played out many times before, and the only danger is when you start drawing too close of a correlation and not analyzing each market and each index on its own.
What do you see as the dominant trends in the next year?
Well, I think it's pretty much what I've just kind of covered there, that I think we're going to see I guess what could be termed a deflationary bottom in a lot of commodities, and I'm even lumping the metals in there. A bottom in those at the end of this year, and maybe even like in crude and some other commodities, the very beginning of 2016, and an uptrend through 2016 in at least price inflation. It doesn't mean that the economy is suddenly roaring back to life. It could be one of these stagflation type of things. So the price of metals, the price of commodities moving steadily higher in 2016, and the price of equities seeing a more sustained sell-off through 2016. Those would probably be the two overriding major trends that I expect for the coming year.
What are your thoughts on when it comes to cycles for the U.S. dollar?
I am looking at, now that goes back even to that 40-year cycle, all the way down to multi-year, multi-month, and even weekly cycles that I follow. They are all prompting me to look for one more wave up in the dollar into 2016. But then the dollar to set a pretty important high and start to roll over to the downside. And there's a fundamental scenario that I've been discussing that the exact timing of it I'm not certain on, but I have certainly seen many corroborating events already take place, and that is a global push to unseat the U.S. dollar as the reserve currency of the world. And there have been, going back to 2010, meetings between a lot of primary nations around the globe, and then the introduction of the New Development Bank by the BRICS nations and the Asian Infrastructure Bank by China. Each one of them is competing for global economic and financial and currency leadership. And even when you look at the XDRs, or they're also referred to as SDRs through the IMF, special drawing rights, the whole push for them to represent some sort of global currency. There's this groundswell of support and of pushing for something to replace the dollar's loan supremacy. And to me, it's one of those things that there's going to be, in the coming years, I believe, and it even links into this whole 40-year cycle, some event, some communique, some announcement, where it's the tipping point, where suddenly all of these developments now hit the point of critical mass, or cross the Rubicon, or however you want to describe it. And all of a sudden, it'll seem like overnight investor sentiment will swing, and it'll be this, what's going to happen to the dollar when all of a sudden every nation on earth doesn't have to hold dollars in order for trade and for banking and whatnot. And I think that that's really the shift that we're going to see in the second half of this decade.
Are you bullish or bearish on oil for 2016, and why?
Well, that goes into those cycles I mentioned earlier that bottom at the very end of this year, very beginning of next year. So from that perspective, and even the hypothetical scenario I described a little earlier, that I think that a significant multi-month, multi-quarter and possibly multi-year bottom will be will be intact, will take hold in December of this year or January of next year, and crude moving away from that low throughout the year. Whether that means a $20 move up or a $30 or $40 advance, my work has not yet, until I see where and how the bottoming formation takes hold, I can't calculate the specific objectives for the year. I have some indications of where I think the next bull market will ultimately take oil, but the timing for that is not specified either. So it's kind of having a time and having a price, but not a time and a price. So I do think that oil will have more of a bull market on balance in 2016, but the specifics of that are yet to manifest themselves in my work.
What do you see ahead for food commodities?
That, again, that's kind of with that whole food crisis discussion, for lack of a better term, food crisis, that I've documented how it has occurred on a 40-year basis. It has also, there's even a longer-term 100-year cycle that has timed major food events, going all the way back to the Great Famine in the 1310s, and really the strongest point of that was the second half of the decade, into the 1710s, which were some of the coldest on Earth, and actually the 1610s had similar cold and also low solar activity. If you look at the period where we saw the least amount of solar activity, and that coincided with the depths of the Little Ice Age, the 1610s and the 1710s were some of the most significant. Then the second half of the 1810s is when you had the eruption of Mount Tambora in Indonesia, and the following year was the year without a summer, where growing areas throughout Europe and the U.S. and around the globe had freezing temperatures at some point during every month of the year. And I'm not necessarily running around yelling the sky is falling, but there are these consistent cycles that challenged the production of food and the growing of crops on a very consistent basis. And in the 1910s, you had as much of a man-made issue with World War I impacting a lot of that in the second half of the decade. And now we're coming into the second half of the 2010s. So you have this 100-year cycle, these 40-year cycles, and then a lot closer, more specific cycles, all telling me that we're coming into an important bottom in the price of a lot of commodities, particularly grains, and we're going to start new bull markets in them, which leads me to believe either there's going to be a tremendous groundswell of demand, or there's going to be some disruption in supply, and that's the one that I think is more likely, particularly when you look at climate cycles and other related things that also come into play during this time period, the second half of the 2010s.
Based on your cycle work, where might the greatest opportunities lie in directional changes or acceleration of the current trends?
That could be in some of the grain markets. In fact, that probably is what I would say, that some of the grains are looking like very good opportunities, but there's still a bit of downside left. I've got some specific downside targets and timing targets as well as price targets in soybeans, corn, and wheat. And once we've reached them, I think that could provide a very good opportunity, at least for an initial surge into the third quarter of next year, which is when some of my more intermediate term work anticipates an initial peak in those prices.
The fifth year of a decade has a record of consistent market advances. Lows in September, October tend to be followed by 6 to 8 weeks of strength, then 4 to 6 week pauses before moving into February. How would this fit into your cycle theory?
I think that everything there except for that move up into February fits with my cycles, and is, a bit of that presidential cycle discussion we had earlier, where the market has very closely adhered to my expectations for 2015, and even one of the correlated cycles that I described back in 2014 that I haven't mentioned yet in our discussions here was a very consistent pattern on a 17-year basis of 10 to 20% declines between late April and late September that you saw in 1998 on the heels of the Russian ruble crisis. You saw it in 1981. It goes back to 64. And so you had all these different things reinforcing that we should see a sharp drop in the middle half of the year almost, middle third of the year really. And so that even fits with that decennial cycle that you're describing. And when last November I laid out this scenario, the end part of it was that the fourth quarter of 2015 would see a strong advance, which again goes right along with that September-October low that you're talking about. So all of that, I think my expectations are very closely aligned with that decennial cycle. It's just that flowing over into February part that I do not think we'll see. I think we're going to see a new downturn before that, but it could wait. All along I've been saying that I thought the real trouble would wait until after mid-December. Even when we were looking for a mid-year drop of 10 to 20%, I kept emphasizing that I thought that would be an initial kind of watershed event or warning flag, but that the real trouble wouldn't take hold till after mid-December based on even some weekly cycles that I follow. There's a very consistent 32 to 33 week cycle in a lot of the stock indices and an overlapping 66 week cycle that has timed almost every significant turning point since the 2009 lows, and that told me to look for an initial drop after late April and a bigger drop after mid-December. So again, that's the one part, that time period of January and February, that contradicts with what I am expecting. I'm more bearish after mid-December.
Eric, where can people go to find out more about Inside Track and Weekly Relay?
They can go to our primary website, which you've mentioned a couple times here, InsideTrack.com, spelled with the extra I in the middle. But I have really been compiling a lot of the 40-year cycle articles and interviews and analysis on a separate website because there was so much information. And that is all posted at 40yearcycle.com using the number 40, 40yearcycle.com, and a similar website at 17yearcycle.com. That's really where you could find a lot of the most current publications and articles at those sites.
Eric, thanks a lot for chatting with us.
Thank you for having me on again, Jim. I appreciate it.
My guest has been Eric Hadik, founder of InsideTrack.com. That wraps up our show for this week. Thanks to our guests, Ross Clark and Eric Hadik. And thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. Join us again next week for This Week in Money.
This Week in Money is a production of How Street Media Incorporated.